And if you look at the black line, which is latest data, it's showing a sharp increase in liquidity since that low point, which came at the end of 2022, actually came in September, October of 22. And then it looks like it's likely to peak out sometime around either later this year or more likely the early part of 2026. So maybe sometime in the first half of 26, we'll be getting concerned. And if you look at the orange line on the chart, that is the reason to start getting concerned. I'm only going to say concerned about what could happen in the next 18 months, because liquidity is going to be absorbed by the need to refinance this debt.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. In his appearance at Thoughtful Money's spring online conference back in March, Michael Howell, founder and CEO of Crossborder Capital, warned of an oncoming liquidity air pocket, which was why the market's subsequent plunge of nearly 20% the following month wasn't a surprise to him. So, where does he see liquidity headed for the rest of 2025? To find out, we'll sit down today with the man himself. Michael, thanks so much for coming on the program today, all the way from London.
Thanks, Adam. Always a pleasure. Good to be here.
Thank you. No, same. It's the same here. And Michael, you are, I like to say, I try to bring on people who have important parts of the puzzle, macro speaking. And you have your eyes squarely focused on a very important one, which is liquidity. Rising tide will raise all boats, and the sinking tide will sink all boats to a certain extent. Liquidity has been playing in a very outsized role, I think, in the financial markets over the past several years, and I think it continues to, at least so far this year. So anyways, I've had a lot of people clamoring to have you back on the main channel here to give us an update on where things are liquidity-wise. So, why don't we just start with that? What is your current assessment of financial market liquidity right now?
Well, I think the short answer is it's pretty good. It's almost difficult to say it's gonna get better than this, but it may well do. There's a lot of liquidity going to markets. That's arisen from a number of features. One certainly in the first quarter after the air pocket was the rundown in the Treasury general account that was already imposed by the debt ceiling in the US. So that launched something like probably overall about 500 billion into US money markets. You've had on top of that the weakening dollar, which has actually caused or triggered easing from foreign central banks. So that's been a second factor. And then as the second quarter has unfolded, you've had another two developments. One has been that the People's Bank of China has injected a lot of liquidity into their financial markets. In fact, over the last 6 months, the Chinese have whacked in about 10 trillion yuan, which is close to $1.5 trillion US dollars. So sizable amounts of cash have gone in there. And then on top of that, if you look at the collateral basis of liquidity generation, which is increasingly important, you've had volatility in the collateral markets. In other words, volatility in the main collateral, which is the US Treasury market, actually coming down. And that's come down against the background where a lot of people have been, as we know, very negative about treasuries over recent months. But volatility has actually come down noticeably, and that's been a positive boon for liquidity. And I can demonstrate very easily by looking at a chart. If I put a chart up, hopefully we can see that backdrop. I think that chart should be clear. That's looking at weekly global liquidity going right back to 2010. There have been a number of gyrations en route, but what I would get people to focus on is one is the big climb in liquidity that you had during the COVID emergency, and that's pretty stark. There's a very sharp incline as liquidity picks up, and then really since the COVID crisis, you've seen this sort of ragged or sawtooth trend, but the trend has been there. The trend is definitely picking up. And it seems to be sort of gaining something like at the rate of about 10 trillion US dollars a year. So, sizable amounts of cash. And if you want to blow that up a little bit more, you can see what's happened since the beginning of 2024. And the latest pickup is there quite clear. You've had a noticeable rise in liquidity. as you said right at the beginning, liquidity is a leading factor. So there was an air pocket likely coming in the early part of the year, as that dip suggests. But since then, we've climbed to new highs. So the liquidity background looks to be pretty good. And that's largely as we see it going forward. It's difficult to argue that liquidity will be interrupted significantly, providing those various parameters keep going. And I think there are doubts clearly on a number of those. I mean, one is will the Treasury build up its Treasury general account at the Federal Reserve as is being slated in the current quarterly refunding
Hmm.
announcement? That's a possibility. If they did that, it would take a lot of liquidity out of markets. But I just don't think I don't think they're prepared to do that, despite the announcement, and I don't think they're able to do that. So I think the liquidity background looks to be pretty good, and we can drill that into that, by all means.
Okay. And when you say that you don't think they're going to be able to do that, what are the main constraints there?
Well, the main constraint really comes back to, let's say, the harmony that is within financial markets that really exists between debt and liquidity. And one of the points that we continually make, if you like, is that there's an equilibrium between liquidity and debt. And the way that the financial system works at the moment is that liquidity needs debt, it uses debt as collateral for liquidity expansion. And debt needs liquidity in turn because debt needs to be refinanced. And if you look at the liquidity cycle is essentially a debt refinancing cycle. And so one's got to look at the gyrations in liquidity relative to the amount of debt that is around. Now, to look at that, and maybe this is a good sort of segue into maybe our current thinking, and I'll try and go on to a chart that illustrates that. Sorry, I'm going the wrong way on this chart. This is looking at the global liquidity cycle as I cited it. This is measuring not obviously not the level of liquidity here. This is looking at the momentum of liquidity, and it's shown as a normalized index in black. And we've got the data here going all the way back to the mid 1960s. The dotted line that's been overlaid on top of that is a sine wave. And just to demonstrate or to emphasize, I should say, that this is not cheating, we drew that sine wave in year 2000 and it hasn't changed since. So we've just, if you like, extrapolated or rolled it on year after year ever since. And so what you've got here is 25 years at least of out of sample sine wave overlay. And that is suggesting that the cycle right now is behaving pretty much as one would expect. And if you look at the black line, which is latest data, it's showing a sharp increase in liquidity since that low point, which came at the end of 2022, actually
Hmm.
came in September, October of 22. And then it looks like it's likely to peak out sometime around either later this year or more likely the early part of 2026. So maybe sometime in the first half of 26, we'll be getting concerned. Now, the question of the $64,000 question is why should we be getting concerned about that time? What are the factors that could be causing this liquidity rollover? Now, I think the best way to look at that is to just go on a few slides and to focus on this chart, and I'll come back to the other ones. But this chart is really at the heart of our analysis. And what it's saying is that the financial system that we live in is essentially a debt refinancing system. Something like 3 out of every 4 primary transactions that go through financial markets are about debt refinancing. And debt refinancing requires balance sheet capacity among credit providers, which is what we think of as liquidity. We don't look at money supply or traditional measures like M1 or whatever. What we're looking at is the balance sheet capacity of credit providers, which is our definition of liquidity. And that takes on a global dimension because money in this sense or liquidity is fungible. Now, what the ratio shows is that there's an equilibrium or harmony here. And it looks as if you've got a ratio of around 2 times between debt and liquidity over the long term. This data goes back to 1980, and this is for the advanced economies in the world. Now, every time that you get a significant increase in the amount of debt relative to the liquidity available to refinance it, you start to get refinancing tensions. And those refinancing tensions are expressed in terms of crises. So our contention is that every financial crisis that you can look back and think of in the last 20, 30, 40 years has actually been a debt refinancing crisis. It's fundamentally, it's formed or it's been initiated in the debt markets. And if you look at the other side of that, below the line, when liquidity is abundant, when there's lots of liquidity, surplus to what you need for refinancing, you typically get bubbles. And I've illustrated a few there. Now, obviously, the interesting one to focus on right now is the current bubble we're in, which you could loosely call the everything bubble, I suppose. And that has been characterized by a huge drop in the debt liquidity ratio. Now, let's just hold that thought and consider why that could have happened. And it's really happened for two kind of connected reasons. One reason is that in the wake of the GFC in 2008-9 and following the COVID emergency, policymakers, i.e. central banks, threw liquidity into the system. And we know that. I mean, that was their way of solving the crisis. They just pumped in liquidity and tried to refloat the system. So ample liquidity, number one. Secondly, particularly during the COVID emergency, interest rates were slashed to zero. Now, zero interest rates are unheard of. My background originally was at Salomon Brothers, and at Salomon Brothers, we were schooled on a book by Sidney Homer, which is still in print, called The History of Interest Rates, which looks at 4,000 years of history of interest rates. Nowhere in those pages do you ever see zero interest rates. That's how anomalous they were. And zero interest rates,
or negative interest rates.
yeah, or even negative interest rates, correct. I mean, this just doesn't happen in history, but it did happen. And because of that, what you found was that a lot of borrowers termed out their borrowing. They just refinanced. And a lot of companies, corporates and governments, households too, basically paid off their loans and refinanced 5, 6 years out at zero interest rates. And though that debt is coming back into the system really around 2026, 27, 28. And if you look at the orange line on the chart, that is the reason to start getting concerned. I'm only going to say concerned about what could happen in the next 18 months, because liquidity is going to be absorbed by the need to refinance this debt. And if you put that into perspective, this is showing the change in the annual debt roll globally. And this is the change from year to year, but it's showing in terms of, this is billions of dollars. So the 4,000 is $4 trillion effectively. So in 2027, you see a peak jump in the amount of new financings by another 4 trillion. So this is not saying it's 4 trillion to refinance. It's an increase of 4 trillion coming on the increase in 2026. So basically, you're talking about a figure of something like $40 trillion of debt simply to refinance.
Okay, and sorry, Michael, I'm assuming that's worldwide, and is it?
This is worldwide, all forms of debt, Adam. So it includes everything. It includes corporates, it includes households, it includes governments. Everything is in there.
Got it. Okay, thank you. That's exactly what I was going to ask. So, we've been talking a bit in the U.S. about the maturity wall of debt that's hitting corporate America, really starting this year in earnest and going over the next couple of years. You're saying it's not a U.S. phenomenon; it's a worldwide phenomenon. It's in all forms of debt, and yeah, these numbers are big.
Yeah, and this is the problem the world has got. Now, if you come to this schematic slide, what this is basically saying is this is the problem. This is the world financial system, generally in terms of a sort of an overview. And what it's saying is you've got this circle or cycle, the debt liquidity cycle, where what I said earlier on is that liquidity needs debt as collateral because something like nearly 80% of all lending in the world economy now is collateral backed in some form. Now, that could be home mortgages or real estate deals, but it could equally be financial transactions that are backed by collateral in the form of US Treasuries or German bonds. And financial market transaction tends to be government bond based, as you know. So a large part of lending now is collateral based, which means that you need that collateral support or stability in the collateral markets in order to make sure that liquidity keeps flowing. And then on the other side, it's saying that you also need to refinance your debt. So you need liquidity to do that. And something like, as I mentioned earlier, maybe 3/4 of transactions in world financial markets are a refinancing transaction of an existing debt. And you need to monitor things like term premium in bond markets or credit spreads to work out the integrity of that side. But to focus on the left-hand side, which is the more immediate question, we need to monitor the stability or health of the repo and collateral markets. And that's not something that people are used to doing because they're more used to looking at things like P multiples of stocks or whatever, or margin debt or whatever the normal metrics. But in this world, you need to understand, in a debt refinancing world, you need to understand the mechanics in the repo markets and the collateral markets. And the two things that I cited, one of those is bond volatility. And this is looking at the MOVE index, which is the Merrill Lynch measure of volatility across the US Treasury term structure. And this index normally ranges between around 50 and 90, with an average of about 70 historically. And the best way to read that is to knock a zero off and say, well, 70 means 7% average volatility across the term structure.
Mm-hmm.
You can see how much that spiked, and it's basically moved up to threatening levels, quite recently actually, of over 150. And when I was sort of, at Salomon Brothers in the bond markets, I mean, people would say if you got above 150, that was sort of turn the lights out, end of story regime. And we've been up there. I mean, at one stage we're up to at 200. So this is showing that you're getting breakdowns in the collateral system, which is really very dangerous. Now, the good news is that we're back in the normal zone. And I think that's been a feature which has been carefully manipulated by the Treasury and Fed together to try and make sure that bond volatility has come down. And whether it be through buybacks of stale or off the run bonds, or whether it's been through forcibly running down the reverse repo account at the Fed, these factors they've actually gained traction in the sense that volatility has come right down. And that can only be a good thing, because what it means is that if you're a credit provider and you're lending against collateral, you are likely to demand a smaller haircut of the borrower from their collateral. In other words, the collateral multiplier will be bigger in a low volatile environment. And that's what we've got. So that's been a feature as well of recent months. So it's certainly helped liquidity. The other feature to look at, and this is, we're getting into the weeds here, but these are critical indicators to watch. This is looking at what goes on in the repo markets, and this is a measure of collateral shortage. So it's really saying, looking at the SOFR spread, the system overnight funding rate versus Fed funds, and that's basically saying, does that spread blow out? If that spread blows upwards, those spikes are giving warning signs that there's either a lack of liquidity in the market or there's a lack of available collateral, good quality collateral to borrow against. But
Mm-hmm.
both of those are signs of dysfunction of the market. So that's what we've got to be concerned about. Now, again, that's come down into a normal zone. That's good news. I think the Federal Reserve has been actively managing that. One of the reasons that I'm optimistic that money market liquidity in the US will remain healthy is that if you look at recent months, every time there's been a slippage in the repo markets, the Fed has come back and actually boosted bank reserves a tad, and they've managed to keep repo rates within this corridor. And I think that's a deliberate policy. Therefore, if the bottom line of this is that if they took, as is being suggested, 500 billion out of money markets to rebuild the Treasury's account at the Fed, to replenish it after the debt ceiling rundown, if they did that, it could force repo rates up against Fed funds by 25 basis points, which you could see they would go right to the top of the scale. I just don't
Mm-hmm.
think they're in a position to do that. So I don't think they will. Maybe there may be some sleight of hand. They may actually announce an ending of QT or something. I don't know. But they simply can't take that amount of money out of money markets. And maybe the sort of the final chart on this bit is to say, well, look, here is the US Treasury market. This is the bedrock on which financial market performance is built. Okay, if you see problems in the bond markets, you're going to get problems in the equity markets almost certainly. The top orange line is the 10-year Treasury yield, the benchmark bond, really globally. The yield on that in orange. I put some tram lines on to try and show where it is. And then the black line at the bottom is actually the term premium or the risk premium on those bonds. Clearly, the risk premium is going up. That's not a great sign, I admit. But if you look at the orange line, which is the yield on the 10-year Treasury, that looks to me broadly stable. I mean, I wouldn't be getting too worried about that. If it broke out of its channel, then there's a concern. And, clearly the trend is upwards. So, make no mistake, this is not wholly rosy. But on the other hand, it suggests a pretty decent platform. So I'd be looking pretty closely at that to make sure that things stay on track. So that's sort of the general picture of what's going on. And I can drill down into a couple of other aspects, if you like, to give a little bit more color as to maybe some of those liquidity dynamics.
Sure. And let me just ask this question sort of as a segue perhaps into that, which is, looking at the Treasury yields, you said, okay, relatively stable pattern. You showed the MOVE index was coming back down into alignment. The SOFR federal funds spread is kind of back to dead even. Those are all kind of green lights on your dashboard of liquidity. Um, I'm just wondering if we should put the word "for now" at the end of that comment, right? Where,
Always. I mean,
because you
there's
talked
no
about,
question.
yeah, because when you went back to your cycle chart with the sine waves and whatnot, you seem to suggest that both sort of historical cycle wise, and then some of the other things that you're looking at macro, that 26, 27 could be substantially rougher years. So I'm curious to know, beyond just, hey, this is the historical pattern, what are some of what do you think are the highest likely triggers for a rollover in liquidity?
Okay, well, let me kind of address some of those points. To come back to this chart, this is looking at the global liquidity cycle, and very clearly there's a cycle there. I think few would dismiss or argue against that. If you go to the previous slide here, this is looking at business confidence worldwide. And what I've done here is to take all the major surveys, so looking at things like the ISM survey in the US, looking at the Tankan in Japan, the CBI in the UK, etc., all these major surveys, and aggregated them by region. So there are about 30 surveys split into different regions here. And what it shows, I think, or what it doesn't show, maybe but more correctly, it's a cycle. I mean, it's very difficult to see cycles there. There's a lot of sort of
Hmm.
noise going on, and there's a lot of flatlining. But it looks as if the economic cycles per se have kind of disappeared. And I think that's why looking at traditional metrics, which focus on economies, is maybe the wrong way to understand these markets right now. And there could be a lot of reasons why that's going on. It could be the fact that you've got fiscal policies playing such a dominant role. Fiscal policy is sort of on or off. It tends not to cycle too much. And traditional manufacturing is being displaced by services. So there's a lot of good arguments as to why maybe the intensity of the cycle in the economy has changed. I'm not going to say disappeared. I wouldn't be that cavalier, but certainly has changed. Now, if you come back to or compare the liquidity cycle with the investment cycle or asset allocation cycle, this is the picture you get. And I'm just going to describe this schematic chart. The left-hand side is the way that we describe the liquidity regimes. So we think of calm, speculation, turbulence, rebound as being four states, or if you like, seasons of the liquidity cycle. And that
Hmm.
liquidity cycle is around 5 to 6 years long. On the left-hand side, we've then said, well, okay, which asset classes typically perform best at each stage of the cycle? Now, what this really runs down to is as the liquidity cycle is accelerating on the upswing, equity markets tend to do best. At the beginning of that upswing, it's technology. At the end of that upswing, it tends to be resource names, more heavy industry that tends to get most traction. Small cap tends to do well later in the cycle. Big cap tends to do better beginning of the cycle, etc. Then you get a phase of commodities doing well around the peak. And then as the cycle inflects, you want to be getting a lot more defensive and moving more into cash. And then around the trough, you want to be thinking more of bonds because you're going to get bond yields coming down, particularly at the long end, giving decent capital gains. And then the cycle restarts. And what I've labeled crudely is the upswing is risk on, the downswing is risk off. And, as I always say with this chart, it's approximately right, but it's always going to be precisely wrong. But, it gives you a roadmap as to exactly where you are. Now, I think if you look at that chart, or certainly if I look at that chart, what I would say is, well, look, we're in a phase now where equity should be doing well. They certainly should have been doing very well. They have. Technology has been an early and leading performer. You're starting to get traction now coming out of smaller cap and areas like financials, as you would expect. You're seeing yield curves steepening bearishly, which is what you would normally see at this phase. You're seeing market leadership rotate from the US market to international markets, again, what you'd expect at this stage of the cycle. You're seeing the dollar weakening, again, what you'd expect at this stage of the cycle. You're beginning to see commodity markets lifting off, again, what
Hmm.
you see at this stage of the cycle. So everything seems to be lined up in terms of where we are in the asset allocation cycle, provided you take a liquidity eyeglass, if you like, to look at, to peer at the asset allocation process. So using liquidity, everything seems to be absolutely normal. Using economies, I'm not so sure, but I think the economic data is being distorted for a whole host of reasons.
All right, this is super fascinating and super useful. So I realize, as you said, what this is generally accurate but precisely wrong, something like that.
Yeah.
But it does provide a really good sort of sequence we should be thinking about as investors in terms of asset class exposure. But it does seem to explain where we are right now. Um, And equities have done very well since the Liberation Day lows. So it sounds like you would expect from here, as this cycle, approaches its peak, which it sounds like you think it's going to between now and the end of the year, that we're really going to see a lot more, capital and momentum in the commodities space. Um, just help me understand speculation here in the chart. And I get it, which means, hey, all of a sudden the good investments are gone and people are just getting driven by animal spirits up to prices that aren't supported by fundamentals. But I feel like we're already seeing a fair amount. Like, I don't know if I would call today necessarily calm versus speculation, because we have a lot of speculative assets that are really catching fire right now. Whether it's the meme stocks again, or the fact that SPACs are coming back into popularity. We're certainly seeing cryptos, which are big risk-on assets, catching big bids. Um, Help me just understand that a little bit. Or is this just part of your, hey, this isn't an exact framework here. There's always going to be some line blurring.
Well, I mean, maybe the term speculation is the wrong one, but I mean, what we're trying to say is you've got four seasons of the liquidity cycle, and by far and away, the best one is calm. When you tend to have a low volatility environment through there, equity markets do well, commodities are beginning to pick up, etc. And then you move into something which could be very frothy, and it may be cycle ending, it may not. But you can get the markets going on for longer than maybe people suspect. And that could be a blow-off phase, and that is typically the speculation. So I wouldn't hold too much to the wording, but it's just really trying to give a flavor. Rebound and calm sound more benign labels than speculation and turbulence. And we've
Yeah.
chosen those deliberately because they're the risk-on categories.
That's when you want to get out of the pool and get into safety assets. Yeah, I
Yeah,
totally get.
you want to be getting a bit more cautious as you move through speculation. So that's really hence the label. Now, I think in terms of a timeline, and you were talking about that. I mean, my best guess would be this, which compares the current cycle, which is shown in orange, with the cycle we saw in the 1980s. And there are two interesting pointers to maybe why it's similar. One is that in 1985, after a period of great dollar strength, there was the Plaza Accord. And the Plaza Accord, and I emphasize the word accord here, because when politicians or policymakers use the word accord, it normally means you're going to get something like a 10 to 20% currency market adjustment. And that's what's typically happened. And lo and behold, with the Mar-a-Lago Accord, we seem to have got something not dissimilar. Now, that particular currency uh, displacement, if you like, or accord, basically has led to, rather like it did in the 1980s, a lot of easing outside of the US, but also coinciding with easing in the US as well. And I'll maybe come on to that process in a moment, but the US has been easing through this period. And what you get is a big increase in liquidity. really backed by a weaker dollar. Now, what is the cycle ending feature? And what was the cycle ending feature in 1987? It was largely the fact that the funding markets, in other words, the bond markets, shouted foul or said, no more, we've had enough. And they began to sell off. And there was a particular juncture, as I remember, in September of 87, when you saw the US wanting to cut interest rates, but the Germans saying, no, 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 enough is
Hmm.
enough. We're going to put our rates up. And markets began to realize that the trend in monetary easing was just changing direction. And that's why there was a very sudden crash. So, if you look at the timeline, we're not there yet. We may be 9 months away, but I think we're moving to that sort of situation. That would be my best guess. And, hopefully I'm wrong, but that's what it seems to me. Now, if we explore some of those statements, this one is looking at what central banks have been doing. Now, let me just explain these two lines. The dotted line is actually very straightforward. It's just saying what is the percentage of all the central banks we monitor, and we monitor around 100. So we're talking about, in physical terms, 80 or so central banks are actually running easy monetary policies. And that's high by definition. The orange line is then looking at, if you like, a size weighted measure of that. So it takes into account that America is a lot more important than Belgium, for example, in terms of its weight, in terms of liquidity. So that is the orange line is taking into account that. But even if you do whichever line you take, it's very clear that central banks have been undertaking considerable easing
Hmm.
over recent months. The volatility, which you might even point to in the last few months, is almost entirely due to what's happened in Asia and particularly China,
Right.
because of the sort of stop-go policies the Chinese have been undertaking. But notwithstanding, that picture looks pretty good. Could it get better? It could get a bit better, but you can see, we're a lot nearer the top. In other words, the end, they are near the bottom, in other words, the beginning. So, this bull market's what, 35 months old. It's getting quite mature. Now, the other thing to think about then is developments elsewhere, which is particularly China. Now, if you look at China, this is showing a metric we monitor very closely, which is looking at injections into Chinese money markets by the People's Bank on a daily basis, or this is a rolling total of those daily numbers. Now, it's absolutely clear, I would say, or unambiguous, that from the beginning of this year, there's been a sizable increase in the amount of liquidity that the People's Bank has injected into their financial markets. And that is material. It, as I said earlier on, it probably accumulates to something like 10 trillion yuan, about $1.5 trillion. They have to do this because China is suffering debt deflation. In my view, they will have to do the same again at least, so another 1.5 trillion. And that would be similar in magnitude to what the US did in the wake of the 2008-9 GFC. So that's what we've got to expect more. And that means that China is going to significantly stimulate its financial markets and economy.
Okay. Totally get that. Let me ask you this question. I'm sure it's been on the mind of a couple of viewers. Um, so, unlike the vast majority of central banks that are there, at least on the surface, the Fed is not easing. Now, I know you'll probably show us your slide in a moment about not QE and not yield curve control. But presumably, the Fed at some point here will return at a minimum to cutting rates, right? And do they do anything else along with that? Who knows? Stopping QT, that type of thing. Um, to the uninitiated, I think they would say, well, that's going to be liquidity friendly. Is that accurate, or is that too simple a conclusion?
No, I think Adam is a very fair conclusion. I think one has to raise the question more and more about whether in an economy which is dominated by the government and particularly by a very large government interest bill, the government is a big, big net debtor to the private sector, and interest payments are transfer payments from the public sector to the private sector, and they're paid for by more debt. Now, in that world, do higher interest rates slow the economy or do they speed the economy up? I think that's a moot point, and I wouldn't like to, answer that particularly because I don't know the answer. So I think
Right.
the question is, do interest rates really matter? Is a moot point, and I would say liquidity matters, but that's always been my case. But I think there's more grounds for it, even more grounds for it now. Will the Federal Reserve cut interest rates? Another question. Yeah, I think they will. I think they have to cut rates because I think if you look at the momentum of the economy uh, on past uh, on past momentum of this level, this slowing level. I mean, the U.S. economy is not in recession, but it's clearly slowing down, in my view. The Federal Reserve probably has to cut rates probably quite meaningfully, and they've definitively slowed down because of uncertainty over tariffs, and I think that's understandable. Is the tariff shock going to cause the US economy to slow further? Almost certainly. Will it cause inflation to pick up? Almost certainly. But I think those are sort of the latter in particular is probably manageable. And I think the Federal Reserve would be, wise, prudent to begin cutting interest rates now. They don't have to go all in, but I think they need to make that move. And US rates are certainly out of line with other international markets, which is actually which is something I think that needs to be addressed. So you've got that point, but to come back to the chart you knew I was going to show you, which is this one, which is looking at sources of stimulus out of the Federal Reserve and the US Treasury. Now, this again is a slightly wonkish chart, but let me try and explain what's going on. The red area of that chart is traditional QE policies. So that's basically the Federal Reserve expanding its balance sheet, injecting liquidity into markets through normal open market operations. That's textbook stuff. The orange area is what we loosely or flippantly called a few years ago, not QE. So they were doing quantitative easing, but they were doing it through the back door. They were injecting money or letting money flow into money markets, either through the rundown of the reverse repo or the rundown of the Treasury General account or the bank term funding program or their losses incurred on holding debt securities and paying up money to banks on reserves. All those factors added to liquidity in money markets. And you can see that orange line and how it's evolved. The black area is what we again loosely called not yield curve control, yield curve control. I think you could equally call that Treasury QE because that's more or less what it is. And if you look at that, what the black line is showing is number one, it's becoming a more dominant part in the future of monetary stimulus or liquidity stimulus. It's overshadowing traditional QE or the not QE stuff, which has really been, that's been almost ground down now to virtually nothing. A lot of it is this Treasury-based QE. Now, that's the thing that we need to understand. What is it? Why is it important? The first thing to say is that if you think about liquidity in generic terms, liquidity or the liquidity of an asset is the size of the asset, the value of the asset, divided by its duration, or you can say crudely its maturity. So, in other words, if you have a very long dated bond that could be 30 years, it doesn't have that much liquidity impact because you're dividing the value of the bond by 30, let's say, you're getting a small number. If you divided that volume of a security by something shorter, like a 3-month bill, so divide by a quarter, you're going to get a much bigger total. And that's what the Treasury is basically doing. It's skewing its issuance away from longer dated debt towards shorter dated debt and bills. And bills are taking up a large part of Treasury issuance, and they will when the Treasury starts refunding again in the next few months. So over the next few months, it'll become the dominant part. Now, with in if you go back a few months, Scott Bessent very prudently said that these are not great policies to fund the US deficit with bills. That's what Janet Yellen did. That's what we sort of labeled Yellenomics a couple of years ago, that funding. That's what you saw in 2024, that black area surging up. And that's kind of cheating, but it's not really very good funding because it's very short term. It's the vagaries of the markets. What's more, and more particularly, it is something which the credit providers, the banks, and the new stable coin issuers absolutely love. Okay, they can't get enough of this stuff. And if you've got a loose fiscal policy, and if you think about this from a bank's point of view, a loose fiscal policy means the government is spending, it's writing checks, our bank accounts are going up, but the banks need an asset on the other side to offset that deposit liability. And if they want to duration match that liability, they go for a bill or a short dated treasury note. And that's why there's a lot of buying by the banks of those securities. Now, the question is that is monetization. And that's what we've got going on in the system. They're printing money. And I keep coming back to this point that what we're in is a world not of financial repression, as people say. It's much worse than that. It's monetary inflation. And monetary inflation means a very, very different outcome. And what you need is dedicated monetary inflation hedges in that world. And what you can see here is the plans of the Treasury, maybe the Treasury and the Fed together, let's hold them to account together. You're seeing this stimulus coming through, which is because fiscal policy continues, but it's being paid for more and more by issuance of very short-dated debt. And I refer you to what Stan Druckenmiller said 2 years ago when he pointed at US finances and said, this is what you'd expect from Latin America, not from the US. But we've got it. And
Okay.
he was talking about Yellen in 24.
Sorry to interject here, but I just interviewed Simon White recently, and he was sort of talking about this dynamic, and he kind of labels it fiscal QE. Is that a good way to think about it? It's
I,
almost like
I
money
mean,
printing, but on the fiscal side?
I don't know if the label I think is not important, Adam, but I think the point is clear that this is basically monetization. And for the sake of maybe showing you a slightly wonkish but important chart, if anyone of your viewers can stand some math,
I think they
um,
can.
this is basically what's going on, and it's very straightforward. This is the top line is the government's budget constraint. G is government spending. R is the interest rate. D is debt. T is taxes. That delta is the change in debt. And M is monetary financing. And what it says is if you rearrange that expression, that budget constraint, you get the second line there that I show, which basically says the G government spending minus taxation minus the change in debt is really a measure of fiscal policy impetus. So that's what the government per se, government policymakers control each one of those things. They control the spending, the taxation, and the funding. And then on the right-hand side is pretty much what the Fed does. So that's monetary policy is they're either expanding monetary financing, which includes sales of debt to banks, and it includes the R, which is interest rates. Now, financial repression is that second box. In other words, keeping interest rates down, right? And monetary inflation is the first of those, is increasing monetary financing. Now, I don't think we've got financial repression because I don't think policymakers have agency over the debt markets. I don't believe they can control interest rates. I don't believe they can set economic growth rates. So how they can force interest rates below economic growth, I don't know. It's never been done before, or more pointedly, if it was so easy, why don't they do it all the time? But they can't. What they can do is they can operate on monetary policy on the left-hand dimension and actually expand monetary financing, which is exactly what we've got. And that's the problem that you're starting to see emerge, around the world now. This is what you're getting. Central bank liquidity is expanding. It's happening in China. It's happening as well in the US through this backdoor mechanism. And as Simon White said, you can call it fiscal QE, you can call it, as I say, Treasury QE, or not yield curve control, or whatever. But basically, these are subtle ways of actually increasing monetary financing. But it all comes back to the same thing. And that's really the great worry that we've all got to start thinking about. We're in a very different world, we're in a debt-dominated world. And maybe as a thought to as we come towards the end of this is, what does China, if China is printing money, what does it mean for markets? Because if the US prints money, I think it's pretty obvious that asset markets traditionally go up. So the
Right.
S&P goes up, Bitcoin goes up, the gold price goes up, etc. But what happens if China prints money? And I think the interesting point there is that what you get as a different dynamic, which I try and show there, is commodity prices. And the orange line on this chart is looking at Chinese liquidity. The dotted line is my extrapolation of what I think they're going to do. Now, you know, this is all in the gift of one person, so we don't know what he's thinking particularly. It could be like Nero's thumb up or down, but the
Mhm.
best guess would be is they've got to expand liquidity to dig the Chinese economy out of its hole. And if they do that, look at the correlation historically between Chinese liquidity infusions and changes in commodity markets. And that seems to be pretty good. So the black line is looking at commodities, the Commodity Research Bureau index, and the dotted line is the one without excluding oil. Whichever one you look at, the correlation looks pretty close. And therefore, if China starts to boost its economy, you're going to get the impulse being felt through commodity markets worldwide.
All right. Well, look, I hate to say this. I've got to start wrapping this up time-wise. I want to note for folks that Michael, as you were in the spring, you're going to be one of the featured presenters at Thoughtful Money's fall online conference. So, folks, we'll get our next update on where we are in this whole liquidity story in October, on October 18th, which is when the online conference is, from Michael. So, anyways, Michael, thanks so much for participating in advance for your participation in that. And we should be a lot closer to 2026 at that time. And so, hopefully, presumably by that time, you'll have a sense as to whether the party's going to continue on into the first half of 2026, or if you're seeing a lot of the warning signs that suggest that, maybe we are really topping and things are going to get rockier here. As we wind this down, so, to your chart that sort of shows where we are in the cycle and what asset classes do well, traditionally in this part of the cycle, you said the baton kind of gets handed from equities to commodities, but it sounds like we might have that on steroids this time, given what's going on with China.
It could be the case. I mean, geopolitically, China is wanting more commodities, and I think you can see that in a lot of ways. I mean, maybe in the energy markets, energy prices have been depressed partly because of US shale, which has filled a big gap. But we know shale is coming down in terms of supply. But equally, the Chinese economy has been actually in the doldrums for some time. If you start to get both of those two factors unwinding, it's like the widening of a pair of scissors blades, that you get a big gap between demand from China picking up and ability to supply being diminished.
Hmm.
And that could be a serious change in both energy prices and then more generally commodities. So I think there are clear supply issues one's got to think about.
Okay. Well, if I took good notes, here's what I would think you would say, but then why don't you just say exactly what you think? But I think you would say, look, equities are running hot right now, and they probably still have, a quarter or two of good running ahead of them. So don't get out of equities, general equities yet. But understand that you're probably heading into the later half of the game. Commodities, potentially a really good time to start increasing your exposure to them, given that you expect them to pick up for all the reasons that we talked about. And then have an eye heading into 2026 that, we may want to start looking for the clouds on the horizon and think about, looking for any signals that suggest we should start lightening up and getting into risk assets, but not do that until we see those warning signs.
Yeah, I mean, I broadly agree. I think people have got to definitively, split a strategic asset allocation, where I would say you've got to have a big weighting in that strategic asset allocation towards dedicated monetary inflation hedges. Things like, good quality equities, things like gold, things like Bitcoin, things like residential real estate, which are great long-term monetary inflation hedges. That's your strategic asset allocation. And then tactically around that, you can take, more pronounced bets, if you like, through the cycle. But I think there's got to be that division. And, what I would be doing, is my tactical asset allocation would be evolving as that cycle says. I mean, I'm still being equities, but I'd be starting to look for, maybe exits or ways to get out and trimming some of my extreme positions,
Hmm.
thinking about commodity producers a bit more because that may be defensive. And then, as that cycle moves down, as you move into the risk off phase, the type of equity sectors that perform are things like defensive value and then defensive growth as you get towards the bottom of that cycle.
Right.
And
And
those,
bonds too, right?
Pardon me, sorry.
And bonds too, right?
Yeah, and bonds and fixed income, longer dated bonds would do well. But that's pretty much why defensive growth equities like pharma or food manufacturers can do well through those phases.
All right. Well, fantastic. Michael, I cannot thank you enough, not just for the great quality of your insights here, but just how generous you are in sharing it all with us. And also at the end here, just making it really practical, right? Okay, practical and tactical. What do we do? What do we, as investors, what should we really be focused on doing here? So as I mentioned, you'll be at our conference, but if folks want to follow you and your work in between now and then, where should they go?
Well, I think there are two or three main sources or avenues. One is our Substack is called Capital Wars. So that comes out two or three times a week, providing both data and some of our commentary. We've got an institutional um, business which provides data, particularly quant data, and that's at crossbordercapital.com. And then there are occasional tweets on X with the handle at crossbordercap. So those are the main conduits.
All right, fantastic. And when I edit this, Michael, I'll put those URLs and handles up on the screen so folks know where to go. Folks, the links will be in the description below this video as well. As a reminder, Michael's going to be speaking at our conference. I'll hopefully have that conference page up by the time this video launches. So if you want to go and I think this is the first time you'll be able to do this, folks. If you want to go and get your ticket for that event at the lowest early bird price, just go to thoughtfulmoney.com/conference. Folks, please let Michael know how much you enjoyed him appearing today by hitting the like button and then clicking on the subscribe button below. And look, if you're a DIY investor, which I know many of the people who watch this video are, highly recommend you consider checking out the resources that Michael mentioned there, especially if you're a retail investor. The Capital War Substack is excellent. I'm a subscriber. I get it daily. But if you are looking for some help in trying to figure out how to navigate the road ahead, particularly if it ends up going the way that Michael thinks, especially perhaps with some good getting in the near term, but then maybe it turn into something a lot more turbulent once we hit the peak of the cycle and start heading down. Then highly recommend that those people who are looking for that help get it from a good professional financial advisor, but importantly, one who takes into account all the macro issues that Michael mentioned here. And when you add that requirement on, the universe actually shrinks pretty dramatically. But if you've got a good one who's doing that for you and executing a plan based on that, fantastic. Don't mess with success. You should stick with them. But if you don't have one, you'd like a second opinion from one who meets that criteria, consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. These are the advisors you see with me on this channel week after week. To schedule one of those consultations, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These are totally free, these consultations. There's no commitment to work with these firms. It's just a free service they offer to help as many people as possible. Michael, my friend, again, just another stellar conversation with you. I'd love to give you the last word here, for just the regular investors who are watching this channel, and we do have a fair amount of professional ones, and folks, you should go check out Crossborder Capital. But for the regular investors, Michael, who are just trying to prudently grow their wealth and more importantly, not lose it, in some sort of big market turn, what would be your parting bits of advice to them?
Well, I think the key thing is to understand liquidity in the world economy. But when it comes to policymakers, watch their hands, don't read their lips. And I think you've just got to see what they're actually doing in markets, and that gives you a very different perspective, and that's what we look at.
All right, very well said. Well, we'll leave it there. Michael, thank you so much. Really look forward to seeing you at the conference in August. Sorry, in
Good.
October.
Likewise.
Thank you.
Thanks.
All right, and everybody else, thanks so much for watching.
Based on Fibonacci, it says based on this rally, based on the strength of the pullback, it's going to tell us where the upside targets for gold are. And so we can look forward and look above. Gold has the potential here to run to $3,722, and it can go all the way up to about $4,100. So if we look at that, you can see that's a 20+% move. And this is a very similar thing we saw in 2007, meaning we could see it not only hit this target, but it could become the crowded trade short temporarily, and we see gold blast through and move up to, $4,500 or something huge. It could really have a big move at this point.
Analysts project a rally into the $3,700 to $4,100 range, representing a move of over 20% from current levels, similar to the breakouts seen in 2007. Goldman Sachs maintains a base target of $3,700 by year-end and $4,000 by mid-2026, while noting that in extreme scenarios, prices could rise to as high as $4,500 by year-end 2025. Momentum is strong, sentiment is bullish, and key catalysts, such as rate shifts, geopolitics, and safe haven demand, are aligning for a potential breakout ahead. Chris, founder and CIO of thetechnicaltraders.com, recalls that back in 2007, gold was expected to rise by about 20%, but instead it rallied 37% as equities peaked and began to decline. Today, analysts observe a similar setup, with gold forming a classic bull flag pattern and Fibonacci targets projecting gains between $3,722 and $4,100. If momentum builds and the trade becomes crowded, some forecasts suggest gold could even overshoot toward $4,500. Should equities weaken, history indicates gold could surge even more strongly, with silver and mining stocks likely to follow. Traders are watching closely for technical confirmation, particularly a breakout to new highs in ETFs like GLD. Meanwhile, physical gold buyers are steadily accumulating, seeing it as insurance before a significant breakout. Once gold truly takes off, physical supply could become scarce as investors with access keep it locked away. That's why many prefer to stack and store gold now before a potential perfect storm drives demand through the roof and makes it nearly impossible to acquire at any reasonable price. Before we examine the video, please click the bell symbol and subscribe to receive updates on our latest uploads. We always value your thoughts and feedback.
This type of scenario, gold actually had an upside move, a measured move in 2007, just as the stock market was putting in a significant top, which I think is close to where we're at right now. Gold should have rallied 20%. Not only did it rally 20%, but it blew past it and went up 37%. And so right now we have a very similar chart pattern. Gold, if we flip back to the chart of gold, has this, I love to use Fibonacci extension, Fibonacci theory. If you don't know it, you have to look into it because it's in everything in the universe. But more or less, it tells us where the upside targets are. Now, based on Fibonacci, it says based on this rally, based on the strength of the pullback, it's going to tell us where the upside targets for gold are. And so we can look forward and look above. Gold has the potential here to run to $3,722, and it can go all the way up to about $4,100. So if we look at that, you can see that's a 20+% move. And this is a very similar thing we saw in 2007, meaning we could see it not only hit this target, but it could become the crowded trade short temporarily, and we see gold blast through and move up to, $4,500 or something huge. It could really have a big move at this point. So
Yeah.
I like gold. It has this giant bull flag pattern. I'm waiting for an extra, like a discretionary trade, just a side trade that if gold starts to break out to the upside, I want to get long and play this move because I think it'll be a very quick move. I think it'll be very strong to the upside. And if you compare what happened in 2007, if we were to just scroll forward,
Right.
we saw the stock market fall 20% and we saw gold shoot up 37%. And I believe we could see something similar. If we were to fast forward this, we would see, the stock market potentially top out and start to sell off, and gold just keeps going higher and takes off. So that's an opportunity. This is a very rare type of setup that's unfolding. And I think one of the key things for, short-term traders is if we look at the price of gold futures here, and I think this is very important for people to understand, is gold did break to some new all-time highs on the futures market, but that's not what I follow when it comes to trading gold for a trade. I like to look at any gold, physical gold ETF, GLD or whatever. If we zoom in on the chart price action, you can see we never did hit new all-time highs back when futures did. So I'm really looking for gold to break above, when GLD closes above 1750 more or less, I'll be like, okay, you know what? This is it. This bull flag is breaking out, and probably we got chaos in the stock market. This will be kind of that play for gold. So gold has got huge upside potential, and I think it'll bleed over to silver and miners as well. I think the people who take physical gold are extremely savvy. They have a ton of cash because they're buying it. I think it's very smart to be loading up on physical gold because there's gonna, I think, eventually be a time, Daniela, when gold is shooting through the roof. Nobody can get their hands on physical gold. It'll be like impossible to get because anybody who has access to it is just buying it up. It's not even getting out to the public. I think getting your hands on it before, obviously, it rallies and potentially we're in a perfect storm for gold and silver to explode to the upside. Um, I think getting your hands on is important. That's what I do. I collect physical gold. I just store it. I keep stacking it. I think that's, I don't really do gold for a trade. This
Right.
gold trade I just mentioned to you is like, I'll jump into an ETF. I'll play that move as a trade, but I do accumulate physical gold. I keep it stored away and I want to have it in hand. So people accumulating the physical, taking massive delivery, I think they're just really savvy investors saying, hey, if this does take off, they want to make sure they have it because a lot of people will want to buy it. And there's a lot of ways to buy gold and you actually don't really own it. There's a lot of different ways that it's done, that you might not actually be able to get it if you really did want it. And the whole world is all fighting for it.
Silver continues to shine, but with volatility, as the iShares Silver Trust ETF is up about 33% year-to-date in 2025, drawing attention from options traders who are capitalizing on elevated implied volatility. Silver remains more volatile than gold due to its smaller market size and dual roles as both an industrial metal and a precious metal. In the near term, analysts and institutions forecast silver to reach the $40 to $50 range, with the potential for $46 to $47 by mid-2026, supported by technical strength and growing industrial demand, particularly in the renewable energy and technology sectors. Meanwhile, the gold-to-silver ratio remains unusually high, suggesting that silver is still undervalued relative to gold. If this ratio reverts toward historical norms, silver could benefit substantially from mean reversion. Gold, on the other hand, is viewed as the global barometer of risk, signaling when something in the financial system is breaking down. Its current pattern suggests a major breakout ahead, with investors moving away from stocks and real estate toward gold. This shift is seen as a warning sign that uncertainty is rising and markets may be approaching a turning point. In essence, gold is flashing caution, while silver offers explosive but unpredictable opportunities. Let's redirect our attention towards the interview now.
So silver is wild. It has a very ugly chart. It has a lot of noise, huge pops and drops, big rallies, big sell-offs. It's definitely more volatile. And I think that has to do with silver is a lot more of a speculative play. It's a smaller market, so it moves faster. Gold I like because it's kind of the global barometer. It's the whole world gets nervous. When gold moves up, it means globally there's weakness and people around the world are seeing something bad happening on the horizon. And that's what the big chart of gold is pointing to is we're on the tip of something hitting the news, something that's going to change everything. I think that's what gold is warning us. But silver does have upside potential. I mean, it's in an uptrend. I think it could rally to short-term wise, the next upside target short-term is about $40.75, not that high from where it is. But as you know, silver, when it does take off, it kind of just shoots and goes ballistic. If we were
Yeah.
to zoom way out on the chart, it can have these
I mean, look at
massive,
that.
explosive moves. And it's really tough to gauge. Silver moves very quickly. If you blink, you can miss it. You kind of have to be sometimes just positioned in it and stomach the volatility. And then if that hits, then you're a part of it. But a lot of times some of these moves happen in 1 or 2 days, some of these big pops and drops. But when we look back on this chart, there is potential though. We see gold shoot higher and silver could go up and tag that, all-time high of $50. It could spike up to that level.
Yeah.
It would probably do similar to what we saw back in 2007. We saw silver. Let's just zoom in on that price action. In 2007, we saw, just as the stock market really started to sell off, we saw silver shoot higher. Percentage-wise, On average, it moved up about 20% or so. And interestingly enough, the chart pattern for gold and silver right now, Daniela, is gold actually has more upside potential. It's the opposite of what you think. It's the opposite of what everyone else thinks. They naturally go to silver for the bigger gains. But for some reason, all of my chart patterns for silver, and even when you compare what happened kind of back over here, it has the same or less potential for some reason based on technical analysis than gold. So I like gold because it's stable and I think it's going to be a big move. But we'll just have to see how this unfolds. Obviously, silver, if we were to go back, silver did have a pretty massive run from these lows. It was roughly the same, about 40% or more from like what gold did. Gold did about 37 as it broke and shot higher. Silver also did about 37, somewhat from the same time frame. So you kind of pick your poison, spread your money between both if you wanted to, right? Exactly. I think gold to me is the ultimate tool of uncertainty, and it looks like it's about to pop and blow up to the upside. And yeah, I think we're on the cusp. I mean, a lot of people, I've been expecting a big market correction to come at any point. I'm not jumping in front of it and betting on a huge correction in the economy and the stock market. If it wants to keep going up, I'll follow the trends higher. But gold is just screaming. It's like something is about to break. Something is wrong. People are moving away from real estate. They're moving away from the stock market. They're going into gold. And yeah, it's just telling us, just be cautious, right? It's kind of that warning sign.
Gold is indicating systemic stress, while silver is presenting high volatility upside, and both metals are setting up for potentially significant rises. The undervaluation of silver and its industrial demand could result in disproportionate gains, even if gold is the better long-term insurance against financial turmoil. When taken as a whole, they show that investors are becoming increasingly concerned about the state of the economy and the potential move away from traditional assets. Could gold's rise surpass current forecasts if there is a significant decline in stocks? Will silver ultimately beat gold in the upcoming bull market era if the gold-to-silver ratio returns to normal? Post your ideas in the space provided for comments below. Please support and enable notifications if this video is helpful so that you can stay up to date with our latest videos. I'll see you in the upcoming video. Thank you for viewing.
So you're seeing retail catching the wave, yeah, which is driven by governments buying gold, right? So they have to get out of the way of the price is running. Now silver's running. Yeah. So that is what's going on. The question is, where's it going? And when I look, well, I mean, when is the situation with America, which is effectively saying it's on the warpath?
Right.
Yeah. I mean, China's saying, yeah, we're just growing, we get bigger and more powerful. We've got 4 times more people than you, and give us 10 years, we'll have as much money. So we'll have 4 times as much money as you. We're the superpower now. And America's going, hold on a minute. No, we're in charge here. And stop that. Stop that getting richer at our expense. No, we see you now. We know what you're doing. You're going to stop that.
Retail investors are now riding the momentum in silver, fueled by governments accumulating gold and pushing prices higher. With the market moving fast, the real question is where it's headed next. On the global stage, the US is signaling aggression as it seeks to maintain dominance, while China, with its massive population and rapid economic growth, is positioning itself to rival America within the next decade. The US sees this rise as a threat and is determined to halt China's advance, setting the stage for escalating tensions that are further driving demand for precious metals. Clem Chambers is a well-known financial commentator, author, and entrepreneur. He highlights that gold is surging because governments view it as the currency of war, a hard asset essential for defense and global power, beyond the reach of paper money or manipulation. With the US and China in open rivalry, central banks, especially China's, are buying heavily, driving prices higher. Silver, on the other hand, has always been everyday money. So as gold becomes too expensive, retail investors are piling into silver as the affordable alternative. Together, this creates a chain reaction where governments fuel gold, retail fuels silver, and institutions can't stop the momentum. For additional information, view the video. Please subscribe and like the material if you enjoy it, to receive the latest updates.
Well, hold on a minute. Gold, oh, gold's a bit expensive now. What? $3,500 an ounce? That tiny little fleck of gold. And silver, I can buy a sack of it. I can buy a load of old quarters from 1935. And by the way, if the world did end, I can go to my neighbor and say, see that chicken? I've got a silver quarter for you. I'll buy it. You can't do it with gold coin, can you? So anyway, the old currencies apply. But silver, see, gold back in the day was not money, it was currency. You have a few gold coins, you put them under the floorboards. It's not everyday money. You don't walk around with it. Now, if you think about gold, silver, copper, gold is for your cash, your wealth, yeah, or whatever counted for banking. Actually put it in a bank, literally bury it underground in the corner of your house. That's how they used to do it. Silver, now that is purse money, that's wallet money. You carry that in a little sack which you tie to your pants. Okay, right. So you don't really lose it because it's in a purse. You might bury the purse if you're having a problem. It might split. It might all fall out. That would be a pain. But you put the copper in your pocket. That is pocket money. So you've got pot money, purse money, and you've got pocket money, right? Which is why if you go treasure hunting, you will find infinite quantities of copper because it was in the pocket and easily lost.
Right.
Yeah. So that is the hierarchy of metals. Yeah. So gold is for cashing. Silver is for high-ish value transactions. Yeah. So that's why it's retail. That's another reason it's retail. So anyway, a retail looks in and goes, look at that gold go. Oh, I'll buy silver. And that's what you're seeing now.
Right.
So you're seeing retail catching the wave. Yeah. Which is driven by governments buying gold. In the old days, your investment banks will go, hey, gold's going on a run. We're short that. We're short that. We're short that. Oh, yeah. We manipulate the price. And retail will go, oh, no, I'm losing money. I'll sell. Oh, I'll take it back. I'll take it back. And you can, and the institutions can do that with retail because retail is, there's always the frothy part of retail that is easily manipulated. But they can't do that to government. That's, that's playing, that's wrestling Godzilla. You are going to lose. Right. So they have to get out of the way of the price. The price is running. Now silver's running. Yeah. So that is what's going on. The question is, where's it going? And when I look, well, I mean, when is the situation with America, which is effectively saying it's on the warpath?
Right.
Yeah. I mean, China's saying, yeah, we're just growing. We're growing. We get bigger and more powerful. We've got 4 times more people than you. And give us 10 years. We'll have as much money. So we'll have 4 times as much money as you. We're the superpower now. And America's going, hold on a minute. No, we're in charge here. And stop that. Stop that getting richer at our expense. No, we see you now. We know what you're doing. You're going to stop that. Well,
Clem Chambers demonstrates that China under Xi has shifted from cooperation to confrontation, reviving Maoist ideas, discouraging Western influence, and asserting power over Taiwan. This has fractured global supply chains, turning critical resources like rare earths and cobalt into weapons of leverage. The U.S. is responding by rearming and rebuilding industries like shipbuilding, which are essential for military strength. Strategic reserves of gold, silver, and critical materials are becoming vital as global trade routes grow more fragile and politicized. Clem emphasizes that this dynamic is reshaping geopolitics. America is pressuring Europe to rearm while also courting India to counterbalance China. Russia, though armed with nuclear weapons, lacks the economic weight to compete. China, however, is a true rival, with far more financial resources and technological capacity. The global stage is being redrawn into blocks, and for ordinary people and markets, the consequences mean heightened risks, disrupted trade, and the urgent need to secure assets in times of escalating conflict. Let's redirect our attention towards the interview.
Xi came in to China and brought back Maoism, which is not good. He said to these children, stop playing computer games, start getting fit, stop learning English, hey, Taiwan, we're coming for you.
Right.
Well, that's what kind of started the ball rolling. Yeah. No, their predecessors were much more, yeah, we'll be your friends. We'll make your plastic junk, we'll make money, and we'll all be very civilized and nice. And, we can all be friends. But Zaya has taken a China exceptionalist point of view in the same way as America takes an American exceptionalist point of view. And in
Right.
fact, the world needs to be more like the Europeans who, up until recently, have been quite laid back. Yeah, we can get on with you. Yeah, build a pipeline. Yeah, let's all do business. Yeah, let's all be friends. Well, that polarity means that all these global supply chains are now fractured. Yeah.
Right.
So you can't actually rely on your cobalt flow anymore or your rare earths anymore. And that's the base of your economic pyramid. And whereas before they were commodities and they just got loaded up to ships and sent to wherever they needed to be, and everybody was, relatively reasonable with each other. Now it's like, oh no, you can't have the rare earth. No, no, no. We've weaponized it. No, no. See how far you're going to get with your business without our rare earth. Oh,
Right.
cobalt. No, no, no. So now countries basically have to build up strategic reserves of all sorts of critical things. And
Right.
silver is good. You start by going, oh, the only thing we need is gold because gold, that's bullets and that we can buy everything we want with gold. And then you go, actually, maybe we can't. Maybe we won't be able to buy it all. Maybe we won't, if they're shipping it and they say, no, if a ship goes there, we're going to sink it. I mean, what's been going on with the Houthis? They've been firing at ships. The thing that happened also that is, I had to check up to see whether it happened, and it actually happened. Trump came out and said, if you've got a Chinese ship and you land containers, we're going to bill you. We're going to bill you 2% of the value of those containers when you
Wow.
land. So if you're a container ship built in China, that's a $7 million bill just to pull up at the port.
Wow.
Yeah, and that's so that America people buy American ships. Not that America makes many ships just yet, so that the ship industry in America will take off again. And why do they want shipbuilding in America? Well, if you can't build ships, you can't build battleships, can you?
Mm.
Yeah, you can't build all those Liberty ships that were built in the Second World War to ferry all that important equipment around the world as you're fighting World War III. Oh, no,
Right.
oops, I can't build ships. Well, actually, maybe we'll build a few shipbuilding. Oh, I can't build ships because I haven't got any iron. Oh, still, no, and I haven't got any I've got no
Yeah.
rare earths. I can't build any planes. Yeah. So that is what's driving all of this. It's basically America rearming.
Wow.
And yeah, exactly. And it's not good. It's like, okay, you could say they have to, they need to, they must. Okay, I'm not going to argue with that. But what that actually means in reality to people like us and to the markets and to the world economy and what is the denouement on that? Normally, these things don't suddenly heal themselves and everyone's friends. That is dramatic, absolutely dramatic. And that drumbeat, I mean, when they had that speech in Europe, it was like, oh no. And then you go, well, I'm just being paranoid. I'm old and I'm paranoid. Oh no, they've done something else. And every dot on the map, it only makes sense when you see it as America rearming.
Right.
And they've told Europe to rearm, and Europe is rearming. Well, that's not good. I mean, okay, forget it. Maybe it's great. I mean, maybe I'll be, old enough I won't care that there's World War III started. But maybe I'll make so much money I'll be in Chile and drinking red wine, crying, but I'll be far away. But nonetheless, it's not. I can't change that. The only thing I can do is look at it and see where there's real returns to be made to
Right.
secure myself and my family. And that's how I look at it. It's, I can't, maybe it's necessary to have World War III. It's nothing to do with me. I can't affect that in any shape or form. But there you are. There is that drumbeat. And they might stop. After all, somebody wants a Nobel Prize. Maybe China is too fragile to get into this Cold War conflict. Maybe it's, Russia versus America all over again. Maybe it
Right.
isn't, whatever. But if you don't realize what appears to be going on, you don't track it, and you don't. I mean, something that is. I was relieved a few weeks ago. Trump was getting angry at India, at Modi.
Yeah, I heard about that.
Yeah, but you realize the moment America starts sucking up to India, that is very, very bad, because in a global conflict, it's China, India, Russia, and America and Europe. right? India is a major player. Now they historically go, nothing to do with us. No, nothing to do with us.
Right.
Nothing to do with us. But if America is really accelerating, it has to make India either neutral or their friend. Because then it's China and Russia. Well, Russia's nothing. Everybody's worried about Russia. Russia's 150 million people with no money. Right? China is 1 billion with all the tech that we love. I mean,
Wow.
forget Russia.
Yeah.
Russia is, not a thing really. I mean, it can nuke everybody. That's the thing it's got. But you take away its nuclear, what has it got? It's got no money. It's got hardly anybody. Yeah, 150 million people versus 500 million people, $7 million GDP versus a $35,000 GDP per head. It's like
Wow.
1/18 of the economic power of Europe,
Yeah, it's a
without
big
even
difference.
factoring America in there.
Yeah.
But China's a different matter. China's got more money, literally more cash. In dollar terms, it has got twice as much cash in dollar terms in America.
Wow.
So if you counted up, if you stacked up all its yuan, and you said that's that much of dollars, and you stacked up all the American dollars in existence out there in circulation, it's got twice as much. Yeah, you fly into Shanghai at the airport, and you fly into JFK, and you think, JFK versus Shanghai Airport in a battle. There's only one winner there.
In short, the world is entering a new era where gold and silver are not just investments but lifelines in a fractured global order. As nations rearm and tensions rise, precious metals are gaining renewed importance both for governments seeking power and individuals seeking protection. The momentum in these markets reflects not just financial trends but deep geopolitical shifts that will shape the decade ahead. How long can central bank demand continue driving gold and silver higher before retail investors face a major correction? Could rising geopolitical tensions accelerate a shift toward a new monetary system backed by precious metals? We'd love to hear your thoughts, so share your comments below. Don't forget to subscribe for more content and hit the like button if you found this video valuable. Thanks for being part of this journey with us.
I think we'll see new highs in the next 12 months. And I think we'll retest the highs in the next 6 months. So retesting meaning 50 in the next 6, and then breaking out to new highs in the next 12 months. I could be wrong on the timing, but it certainly seems like that's a very intriguing timeline to follow because of the volume we're seeing of purchases post days of declines. We're seeing clearly the outperformance of silver even when gold is falling, and the reaction that even technical analysts that tend to push these movements from a momentum standpoint are beginning to see the probably greatest cup and handle we've seen in history that is still not, have not ended. We still need to see the other side of that handle really break out.
The silver will retest its previous high of around $50 within the next 6 months and likely break out to new record highs within a year. While the exact timing could vary, the outlook is supported by strong buying activity on market dips, silver's resilience compared to gold, and technical patterns, particularly what may be the largest cup and handle formation ever observed, that suggests a powerful breakout is still ahead. Tavi Costa is a macro investor and portfolio manager at Collateral Capital, best known for his deep research on commodities, precious metals, and global macro trends. The classic cup and handle pattern starts with a massive price surge, like what happened in silver during the 1970s, followed by a peak in the 1980s and then a long period of decline and loss of confidence that lasted about 20 years. That long downturn marked the bottom of the market, and by the early 2000s, silver began another cycle, eventually retesting its previous highs. Each time prices return to those old highs, selling pressure often increases because investors fear a repeat of the past. However, the recent decline in silver wasn't as deep as the crash of the 1980s, and the industry has recovered more steadily this time. Now, silver is once again pushing toward its historic $50 peak, and with so much momentum behind it, many believe a breakout is coming. In markets, there's a saying that there's no such thing as triple tops, suggesting silver won't stall out again, but instead move higher once it clears resistance. For investors, the takeaway is clear: prepare for the possibility of much higher silver prices, but the broader setup strongly favors silver's long-term upside. As we present clips from the video, please like this video, subscribe to our channel, and turn on the notification bell to stay instantly notified every time we upload a new video. Thanks for the support, and enjoy the video.
If you think of how a cup and handle is formed, initiates with a large movement that is usually unprecedented, which happened in the 70s, and then peaked in the 80s. And then you have this complete loss of faith and a peak of a bubble. And that goes on for a long time, 20 years or so, of which was the case until the late 90s. And after we saw that, that was the very bottom of that market. So we went all the way up and created the beginning of another cycle, which was the early 2000s, until we retested the highs of the prior bubble. And so investors look at those two things and say, well, that looks like, that same issue we had in the past. And so the selling becomes more pronounced at those levels. And it's normal to see that type of pressure creating another long-term decline. The difference is that this decline although it was very difficult for those invested in this industry. I wasn't involved with the industry personally, but I clearly that decline really shaped the industry in a big way as well. But it wasn't as deep and steep as we saw in the 80s. So that decline, although marked, in a huge way, the history of silver, it was definitely, much easier to stomach relative to the 80s. And so now, we're seeing another movement to push again to that same level that we saw the peak of the bubble in prior times. The thing is, there's so much energy behind this to see the price breaking out. There's a joke that we say in markets, there's no such thing as triple tops. And there we have it, approaching a triple top. There's going to be maybe a moment where we hit that 50, and nobody knows if that's going to be the case. But there's a very high likelihood that we may hit the 50 and people will say, well, that might be it. We might hit a peak here. I don't think that will be the case because cup and handles break out. And so we may see a short-term movement. This is why I said 6 months to get a 50, 12 months to break it through it. But I do think, regardless of the timing of how this whole thing will resolve, I think the resolution is we're going to see much higher prices. So if you're investing in the space and you have that view, you can apply that in markets. Look at if you're running a mining company, you can see this. All right, well, there's a clear path that we may see a break of silver prices. What is my biggest risk here? One, that I'm wrong. You could always be wrong. But two, how do I secure my margin? Because that's the biggest thing. That's your biggest treasury. So this is why I'm urging people in the space to say, protect your margin, because your biggest risk right now is energy. It's not the stock market, it's energy. And in some cases, investors may have issues with maybe labor costs and others. And so it depends on the structure of your costs. But usually energy is about 30% of your cost, particularly coming from open pit projects. And so, yeah, that's the way I'm envisioning this whole thing. And as an investor, if you are in that side of the market, then, act accordingly. Think about companies that will be in a great position if prices reach those levels and plan for that, really try to plan for it. And yeah, that's the way I invest. That's the way I do my things. And, if things change and the plans change and there's another pandemic or something along those lines come and we have a major change in markets, sure, I'm allowed to change my views. but having a plan is important. And so that's how I'm trying to approach this.
Tavi Costa explains that gold has led precious metals and hard assets for a while, but markets often rotate leadership between commodities. Although gold functions more like a currency, it has acted as a commodity and signaled the start of a long-term bull cycle in the sector. Recently, however, other metals and related assets have begun outperforming gold. Tavi relates this situation to April 21st. Gold has moved mostly sideways, while the TSX Venture, heavily weighted toward precious metals, rose over 30%, and silver gained double digits. This shows investors are becoming more comfortable with gold and are now moving further along the risk curve, seeking higher returns in less liquid assets like silver and mining stocks. The trend suggests we're entering a phase where other metals catch up to and potentially outperform gold. Moreover, Tavi exposes that we're in what could be called a golden age of mining, as profit margins are exceptionally strong with gold and silver prices far above production costs. However, this may not last forever, so miners should hedge energy costs to lock in profitability. At the same time, the industry faces a major challenge. Reserves are being depleted, few new discoveries are coming online, and exploration budgets remain low, leaving most major miners with very limited replacement reserves. Now, let's just dive into the interview.
Yeah, I do. I think that would be a normal behavior of the metal. We've had, gold really leading the pack of precious metals and hard assets for some time now here, especially in the commodity space. And I think investors that understand the commodities, sector very well will appreciate the fact that there is a rotational dynamic that usually happens where a commodity will take the lead versus another at certain times. And I'm not here to claim that gold is necessarily a commodity. I do view it as a currency, but it acts as a commodity in that case. And I think gold has been signaling that for some time now that we've seen finally the beginning of a long-term cycle in this whole industry. And we're now what seems to be the beginning of other metals and other derivatives of the gold-related trade or investment starting to outperform gold itself. If you look at the gold price all the way back to just April 21st, when right after the whole situation with tariffs and so forth, the Liberation Days, which happened in the 7th, but gold really peaked in the 21st. We've seen gold basically go sideways. And at the same time, we saw the TSX Venture, which marks a lot of especially if you look into the subgroup of precious metals, that whole space was up about 30+% during the same time that gold was basically flat. So, certainly there has been an exercise that I call of acceptance of risk occurring across investors that are looking for the next thing after gold. That doesn't mean gold is going to go away as a trade, but it means that investors are so comfortable with the gold idea that they're starting to go down or go up on the risk curve and go down on the liquidity curve in order to hopefully capture more returns. And I do think that's going to be the case. And so, I'm paying attention to that because silver has also outperformed gold since, silver's up double digits since gold has been basically flat and down, in fact, since April 21st. So all these things are really interesting. And I think that's the beginning of other metals catching up to gold prices finally. We're seeing what I like to call the golden age of mining, mostly because the margins of these companies are just outstanding. And you can see that in many ways, especially looking at the gold to oil ratio, the silver to oil ratio, and obviously looking at the median cost to produce gold today or silver is drastically lower than the actual price of those commodities or those metals. And that's probably, I don't know if that's going to be the case for the long haul, because I do think energy cost is way cheaper than has ever been relative to metals. And so if you're a producer, you definitely want to be making decisions to hedge energy costs if that's a big issue for you as a miner. I think that's a very important point to to hopefully miners will take that strategy as an approach to secure some of those margins over the long haul. We certainly have done that with our own mine, San Cristobal, which is the fourth largest silver mine in the world. We have instructed them to, and they have done it, basically hedge their energy costs for the 3 years out. And I do think that that's, eventually we all know so we were talking about political constraints. Let's talk about industry-wide constraints. One of the largest ones certainly is what we have in terms of the depletion of reserves and no new discoveries coming online. If you think about how many development stories are going to be coming online to become producing assets, it's very small. And also, if you look at the exploration budget across most of the major companies and how much they have found in terms of added ounces, and it's also very small. So the replacement reserve is actually very low today across most of the majors.
Silver appears to be on the verge of a historic breakout, supported by strong technical patterns, resilient fundamentals, and a shift in investor appetite from gold toward higher risk, higher reward assets. Mining companies stand to benefit enormously, but only if they manage costs and secure future reserves. For investors, the setup points to a rare opportunity in both silver and quality miners, though timing and risk management remain key. Do you think silver will finally break above its $50 resistance this cycle, or will history repeat with another stall? How should mining companies balance short-term profitability with the urgent need to replace dwindling reserves? Please leave a remark in the section below with your ideas. Please remember to subscribe to receive updates, and if you find this helpful content, kindly give it a thumbs up. We are grateful that you joined us on this journey.